The Italian banking crisis spells the ignition of a Eurozone crisis. Welcome to the Shakaama live show with your host, Shakaama. It wouldn't be summer without Europe threatening world domination. It wouldn't be summer without Europe threatening to upend global financial markets. The looming threats this year comes from Italy and its long-suffering banking sector. Quote, as we trend into the second half of the year, the situation in Italy and its spillover for the rest of Europe will continue to be one of the biggest macro-political risks we are concerned about, said Federico Stanti, a London-based analyst at Eurasia Group, a risk consulting group, in a note. The focus on Italy comes after the UK voted in late June to exit the European Union. In a worst-case scenario, analysts fear Italy's banks problem could threaten the country's membership in the Eurozone. In coming weeks, the situation has the potential to create at least near-term global market turmoil as financial and political risks collide. It also threatens to catch many investors who had assumed the world's banking woes were largely in check after the financial crisis by surprise. With that in mind, here's a short guide to what you need to know about Italy's banking crisis. Italy's banks are neck-deep in non-performing loans. Official data puts the total amount of non-performing loans, or NPLs, at around 200 billion euros. That's $220.5 billion, or around 8% of total loans. But some analysts argue that another 160 billion euros worth of loans could soon be pushed into NPL status, according to Wells Fargo, which would put the NPL ratio at an eye-popping 15% of their loan portfolios. Italian bank shares have been hammered. The focus has been a Siena-based Banca Monte dei Paschi, BMPS, which is up at 6.28%, or BMPS. Founded in 1472, BMPS is Italy's third largest bank by assets. The European Central Bank earlier this month asked BMPS to cut its gross non-performing loans exposure from 46.9 billion euros in 2015 to just 14.6 billion euros by 2018. This amplified worries about the solvency of BMPS and the Italian banking system and heightened concerns about the potential showdown between the Italian government, headed by Prime Minister Matteo Renzi, and the European Commission over new restriction on government bailouts of the financial sector. Results of stress tests by the European Banking Authority due in July 29th are expected to share more light on the capital needs of the Italian banking sector, potentially serving as a spark to renewal financial turmoil. Shares of the world's oldest lender have plunged 24% since the end of June and are down nearly 75% in the year to date. Other Italian banks have also suffered, leaving Milan's FTSE MIB index at 1945, which is up 1.96%, down nearly 21% year-to-date, lagging well behind European peer and the Pan-European Stocks 600 SXXP, which is up 0.71%, which is off 6.2% so far in 2016. In a word, no. Weren't the banks fixed after the financial crisis? While Italy was widely praised for reforms in the wake of the crisis, most of the measures were relatively modest, wrote Ben May, lead Eurozone economist for Oxford Economics, in a note. In the end, Italy failed to restructure its banks in a meaningful way, May said. And the financial sector's woes have only been exacerbated by persistent sluggish economic growth. Throw in low yields on Italian government bonds and failing interest rates, which weigh on interest income, and it's no surprise Italian banks are suffering. Can Italy just bail out the banks? Here's the big rub. Under the new European Union rules, bondholders must take a hit in the event of a public bank bailout. The rules are designed to prevent leaving taxpayers to foot the bill for bank rescues. The problem is that around a third of the bank bonds in Italy are held by household retail investors, noted Silvia Merler, affiliate fellow at Bruegel, a Brussels-based think tank, in a blog post. Merler explains how there were maybe wriggle room under the convoluted EU rules. There's also the possibility that bondholders could be compensated for being victims of mis-selling of the bonds on the first place, which could soften the blow, Merler and other observers say. But such compensation, which was seen following the rescue of the foul smaller banks last December, would still require a lengthy arbitration process and may only partially offset the loss to bondholders, Santi said. The situation presents a difficult dilemma for Renzi. A taxpayer bailout will irritate voters, which, falling to protect bondholders, also would risk a backlash. That would empower the so-called Eurosceptics five-star movement founded by comedian Beppe Grillo ahead of the October constitutional referendum. If the referendum in Renzi's reform agenda fails, he has vowed to step down. So what happens? The Financial Times has reported that Italy is weighing a private sector solution to rescue chronically troubled BMPS and an end run around EU bailout curbs. According to the reports, Italy is exploring measures that would see bad loans bought up at favorable rates with money from private and state-backed institutions, including an existing privately backed bailout fund called Atlante. It isn't clear how such a plan would be received in Brussels. European officials are seen as reluctant to back off on the new rules, but are equally afraid of sparking a political crisis that could bring down Renzi and threaten an anti-Euro backlash in the Eurozone's third largest economy. Quote, "There's too much at stake in Italy, politically and financially, for policymakers to fail to agree on a sensible plan to recapitalize Italian banks while shielding the small retail investors who hold a significant portion of the country's bank bonds," wrote Nicola Spiro, partner of Larese Advisory, in a note. Foreign exposure to Italian banks is relatively contained, noted by Jay Bryson, global chief economist at Wells Fargo Securities, in a note. The bigger worry, analysts say, is that a backlash over the bailout leads voters to revolt, empowering the five-star movement, which has called for a referendum on Eurozone membership. The prospect of a five-star-led government likely would lead to a surge in bond yields, credit rating downgrades, further economic slowing, and adding trouble for banks, a scenario that would likely require Italy to seek assistance from the Eurozone, said May of Oxford Economics. That could lead to a chain reaction, he said. Here's one scenario. As a result of all this, an Italian government led by the five-star movement might plausibly go into negotiations with the Eurozone counterparts, believing that it holds the trump card, namely the threat of a referendum on Eurozone membership. This would make it difficult for the Eurozone to play hardball with Italy or kick the can down the road. Policymakers would thus be left with an unenviable choice of either calling Italy's bluff and potentially sparking a regional or even global financial crisis, or fast-tracking integration plans and sanctioning greater burden sharing. The electoral cycle in the region will further raise the stakes, while the French government might be happy to agree to greater burden sharing. Such as a deal would be politically suicide for Chancellor Merkel in the build-up to the German federal election in 2017. The bottom line, May said, is that Italy could be a ticking time bomb. Thank you for watching the Shakaama Live Show. Please subscribe, like the video, share it.